Hello and welcome to the download. I'm your host, Dave Richardson, and it is a super snowy Tuesdays. Record-breaking snowfall in Toronto for January. Stu, did you see that? Did you see that stat?
I did. I felt that stat being
Yeah,
outside. It was nice and light, fluffy snow though. At least
that
if
that
there's a
that
silver lining.
that was the silver lining. But going back to some of the previous conversations that we've had, because we've talked about snow and your meticulous yard care, and which carries from summer through fall with the leaves and into winter. What was the deepest the snow got on your driveway between your shovelings?
Well, I do the walkways. I have to admit I do have some help on the driveway because I got a long narrow driveway. But I did make sure to get out there and tip my cap to the snowplow guy because he's had a hell of a January. 100, I think 100 centimeters of snow in
Yeah,
January.
yeah,
Um, in my walkways, it was like, especially where the wind was blowing, it was pushing 5 6 feet, no problem. It was well over my head in some cases.
really.
So it was something else. But again, light, nice and light and fluffy. So uh, you know, you always have to find the silver lining.
Yeah, one of our dogs ran out, kind of did a jump and up into the snow pile and just disappeared. It was that light and fluffy, and there was
Yeah,
and there was enough of it that medium-sized dog, but just kind of
yeah.
disappeared in the snow. But it's been something else. You know, the craziest thing about that was they've only been keeping snow records in Toronto, official snow records, since the late 1930s.
Hmm.
I would have thought they would have been so.
Yeah,
So it's only like it's not even the worst in 100 years, but it was a lot.
yeah. Well, someone was reminding me. I guess it was almost 20 years ago when Toronto called in the army or something like that
Oh
for
yeah,
one
yeah.
of the blasts. So uh, yeah.
But what people don't understand outside of Toronto is there's just nowhere to put the snow. That's the problem.
Yes, that's right. That
That
is the
that
problem.
that is the problem.
Yeah.
So again, record-breaking snowfall in January and probably record-breaking craziness in January in markets. And we've been away for a couple of weeks, so we'll maybe do an investment stew here. The as much snow as we got in Toronto, I think they got more snow in Greenland this month. So we've once again been through and continue to go through. I mean, I just don't think it's going to change an incredible news cycle that has proven to move markets. And now it moved seemed to be moving markets a lot more last winter and spring than it did this time. But nevertheless, the noise around that discussion with Greenland and the World Economic Forum and other things that are going on around the world did move the market. But then, lo and behold, again, oh, after all the tough talk, pull back, calm down, just as if nothing happened, and then on to the next subject. I mean, I don't know how a typical investor or just an average investor like myself, well, I know it's tough, but how and we've talked about this before. How do you get through this? I mean, you're managing billions of dollars of people's money. Stu Kedwell, who by the way is the global head of equity of investment management for RBC Global Asset Management. So you've got a lot of pressure, a lot of money that you're managing. How do you do it?
Well, you have to, when you see the headline, which many of us see headlines that are like, "Wow, that's different,"
Yeah.
or that's unique," and then often there'll be more information when you kind of scratch the surface and get beneath things. So, even on Greenland, the president was kind of saying one thing, and then you would read from some of the Joint Chiefs and things like this that there really wasn't any plans, to do anything like that. On the weekend, they brought up the idea of more tariffs on Canada.
Yes.
Should we sign a free trade agreement? And then in one of the side conversations, it was the agreement that was signed with China a couple of weeks ago didn't count as a full free trade agreement, right? So it was it was kind of like a shot across the bow, but the boat had nothing in it, right? Like it wasn't the kind of main event. So, um, there's no question to your point is that the market has shown an extreme willingness to dismiss or believe that the volatility that could be created by these announcements uh, doesn't really find its way. And I think that's really been because underlying economic growth has kind of been ratcheted upwards. Earnings have been pretty good, and a fair amount of positive commentary from a fair number of CEOs. So it's this kind of ongoing balance of exactly what the market's going to focus on. The one thing that you always do want to try and pay a little bit of attention to through periods of noise, and it seems like the period of noise has been lengthy.
Yeah.
So sometimes you see a stock go up, you see a stock go up, you go down, or an asset go up, an asset go down around some of this activity, but you're looking for higher highs and lower lows, and for a little bit of a tell. And one thing that has kind of resumed in all of this is the U.S. dollar weakening
Yeah.
a little bit again. So currency moves can be very long term in nature. So this is kind of maybe the resumption of something that has been taking place for 12 or 18 months. And it's modestly against some of the developed nation currencies, but more so against EM currencies. That's where we've seen a more significant move. And then from an equity market standpoint, again, the EM markets have been quite strong. Emerging markets have been
Yes.
quite strong.
Yes.
And so those are some long-term trends where the U.S. has really been the dominant equity market. And so when you have these long-term trends, you have like a downtrend, and then you often have a period where it might be more flattish, like so, and then it starts to reverse. And on some of those long-term trends, EM markets have, along with some other Japan and a few others, have been kind of the first to start to outperform the U.S. markets. And we've talked about this in the past, whether or not this is the end of American exceptionalism. I don't think. I think it's too early to tell on that front. But that rapid period, or lengthy period rather, of American markets outperforming their global peers was roughly a double over 10 years,
Yeah.
which is significant. And a chunk of that was due to earnings growth, a chunk of that was due to American valuation expansion, and a chunk of it was due to the strength of the U.S. dollar. So seeing one of the tailwinds maybe become a bit of a headwind on the dollar front, and then from markets themselves, starting to see a little bit of outperformance, from emerging markets and a few others. So we'll just have to kind of continue to watch that. But that's if you looked at a stock specific move around some of this news, maybe they went up, maybe they went down. There wasn't really any material change throughout all of this. That some of the changes in the dollar and market leadership have been a little bit more persistent. Um, so that's kind of at the macro level. Like within the markets, it's interesting. Um, like consumer staple stocks, had a spectacular
Yeah.
early part of January, but that was coming off a very depressed level, and you might be a little bit less willing to say, well, that's the beginning of a new trend. So those earlier events we're talking about, the beginnings of like on a monthly basis, things starting to make new highs, and it doesn't all happen at once, and then they consolidate and they make a new high, and you begin to see new leadership emerge. But even in the last month, we saw a lot of volatile activity that I don't know if we'd be quite willing to say, well, that's a new trend.
Yeah. And I think for people who have listened regularly over the last 5 years to Stu's days, they know that we've been talking for a while, a couple of years now, about the idea that at some point the U.S. outperformance would run out of steam, and the weakness everywhere else would would create an opportunity that would ultimately become compelling and that people would move in that direction. And we've seen for the last 18 months really that play out, which is one of the reasons you should subscribe and watch us on YouTube. But the continuation of that. So we sort of saw the U.S. dollar come off, from its high. I think the U.S. dollar index peaked around 114 and then sort of fell down in the mid 90s, rallied back above 100, and is now sitting, around 96 today. So as you say, you had that level off and sort of pop back a bit, but now the longer term concern around the U.S. dollar has picked back up again, and that has an impact for, again, the appetite that people have for U.S. investments around the world. And so then you look somewhere else, and you found lots of opportunities, including Canada. That's of course getting a big lift out of a couple of areas that I think everybody likes really all over the world, which is financials and then base materials.
Yeah, so yeah, definitely, banks have been strong all around the world. Copper's been strong, and then, where we get into, gold and silver have been very strong in
Yeah,
relation to, the U.S. dollar. Uh, Gold, as strong as it's been, is kind of like the distant cousin to silver
yeah, yeah,
in the last, 3 or 4 months. And these areas of the market are a bit tougher. Gold has had a strong bid for all sorts of reasons. Maybe the U.S. dollar is weakening. Geopolitical concerns, central banks buying. A laundry list of reasons. What we know about gold when it moves is it tends to have uh, you know dramatic periods of movement in a short period of time, and then a long period of very little movement.
yeah,
And the funds have participated uh, in the move so far, but you're always when you get this overbought, you're always trying to figure out, like, are we due for some consolidation or corrective activity? And the stats in silver are kind of even more stunning.
yeah.
In terms of distance above a 200-day moving average. The case for silver is also interesting because it has industrial usage in addition to participating in the kind of goldish store of value. But when you get to be technicians like to look at moving averages. So like the 200-day moving average would be the average price over the last 200 days. And when you get north of 100% above that 200-day moving average, that's a number of standard deviations above the history. It's not the highest it's ever been, which was
Sure.
when I think the Hunt brothers,
Hunt brothers. Yeah,
yeah, and that
yeah,
was almost 50 years ago, and there was this big squeeze in silver, which shot it up. But I think many market participants also look at that activity and say, uh, at some point there likely would be, a correction. Um, it's hard to sustain itself at those levels. Whether or not it goes sideways or it actually corrects downwards, time would tell. But it wouldn't be something where we would be rushing to, put new money into something, that far above its moving average. And I think unfortunately that's kind of been, these kind of a bit of a rolling. Some might call it a bubble. Maybe it's just rolling enthusiasm for different markets. It's kind of like love them and leave them. We've seen that a little bit in the last 12 to 18 months. And when you own them, it's great. You get this kind of tremendous performance, and you have to ask yourself if you're going to sit tight and stay. And if you don't own them, when it gets to a certain period of extreme, you just have to say, well, I kind of missed that one, and I'll find the next.
yeah. And it's just a case of, so when you say you look at that 200-day moving average and you get to 100% of that, so you get basically double that
Yeah,
in pricing, and you start to go is you start to look at risk reward or upside downside, right? And so how much more upside am I going to get for this risk that if it just drops back down to the average of the last 200 days, which is significant
yeah,
in and of itself, because that's everybody's kind of bought it over almost the last year. Uh, that your upside downside, it starts to suggest, hey, that's not where I want to go. But what you often see is the momentum and the enthusiasm carries people instead of making them look, say, hey, should I be taking some caution here?
Yeah, like
Because, yeah,
the analogy I would draw is like, so I like cookies, right?
oh, yeah,
So I might in the summertime might be like a cookie a day,
yeah,
you know, like, and then September rolls around and maybe it becomes 2 cookies a day, and then I get to Thanksgiving and maybe it's 3 cookies a day, and by Christmas Eve I might be at, yeah, maybe not quite this high, but maybe like eight, ten
oh,
cookies a day. Would I go that high? I'm not sure. Um, but then what happens is I stop eating cookies. So that's kind of what happens around the momentum in a market, right? Like it feeds on itself to a point, so to say, and then it hits a point where you're just like, no, I'm not interested. So you tend to get this very and the last days of the move can be very significant, and then when it kind of peters out, that can be quite dramatic as well. And I think that's why I use this analogy of like, I might be eating, cookies on December 24th, and you would not want to assume that the same number of cookies will be ate on December 26th because New Year's resolutions come along and what have you. That's the same thing that
sure,
happens in momentum markets, right? It's like
yeah.
there's this enthusiasm to be involved, and then when the last person is involved, the price action can be pretty volatile.
Yeah, or that you're going to start to eat 10 cookies in the early in the new year, and then
Yeah,
Valentine's Day 12 cookies, and then you just project it out, and you're not going to get to a point where you're eating 100 cookies a day.
that's right.
Although
Well, guy,
we do have some YouTube of a higher cookie eating Stu Kedwell. If you
yeah,
go back and look at the archives on this podcast.
yeah. Well, guy can dream, 100 cookies a day. You don't get cheeks like this not eating cookies, let me tell you. Um, but that's we've seen that in a little bit. We got off topic here, but we've seen that a little bit in the
Yeah.
some of the markets.
No, well, it's exactly right, and we've raised Warren Buffett on this podcast. So if people again watching on YouTube, they can see your wall with lots of quotes, and there's a few Buffettisms in there. But but one of Buffett's things on gold is like gold is worth what someone's willing to pay for it because it doesn't do a whole lot for you. I mean, you can make some jewelry out of it, and I guess I've got a couple of teeth in here that I'm going to pull out if it goes any higher. But really it doesn't do anything. You don't earn interest on it. It doesn't produce something. So it's really worth what you're going to pay for it. And at some point, just like your cookies, you just can't eat anymore. You're not going to pay anymore. And that's when you typically see, as you say, it moves in fits and starts. The analogy I was drawn for gold was, okay, we're in Canada, so we can talk hockey, right? You got somebody who scores. You got a hockey player. He comes out and dances around. He's a really great skater and very offensively oriented. And he comes out the first game and pots 3 goals, and you win, and everyone's happy. And it's like, wow, that guy's great. And then for the next 10 games, he's out skating around, but he just kind of disappears. The other team scoring a bunch of goals, doesn't take his defensive responsibilities very seriously. And then, lo and behold, 10 games later, he pots 5 goals and he's dancing around. And everyone's, wow, that guy's what kind of talent? And then disappears for another 10 games. That's kind of gold, right?
Yeah,
A shiny hockey player is like the shiny metal. Really good at for short bursts and then really nothing for long periods of time. And again, you can take advantage of that, and you do take advantage of that in the portfolios you manage. And there's certain circumstances that are going to favor gold, which can draw you to when you might want to have some gold in your extra gold in your portfolio. But you've got to realize that's a pretty strong pattern that's been established historically, and that it's not for everybody.
yeah, and it lends itself to different comparisons as well. Like when you see uh, enthusiasm in one area, and then you go look for some areas where there's very little enthusiasm. And you can kind of sit there and dream the dream and say, "Wow, could there ever be enthusiasm in this area?" And maybe I should, plant some seeds today. The energy sector has continued to do reasonably well this month, but when at the turn of the year, I looked at one of Canada's biggest gold companies, and I compared it to one of the largest energy companies, and the free cash that the two businesses generated was the same in dollars.
Yeah.
Yet one's market cap was 50% higher than the others. and the gold cash flow is based on, $45 to $5,000 gold, and the energy cash flow is based on $60 oil. So, could you ever imagine, $75 oil? And could you imagine the same free cash yield as the gold company currently trades at? The interesting thing in that case is you don't have to bet on either two to get a reasonable return. And if either of those two take place, you get a very good return.
Yeah.
So, like anytime, we talk about, some of these rapid market movements, what we're always trying to do is look at those rapid market movements and compare them to other areas of the market. Like, you mentioned Buffett when, I can't remember exactly what the analogy was, but he said, when gold was very strong, and he said, if you took all the gold in the world, you could have, all the farmland in the United States, you could have a number of Exxon Mobils, you could have, this kind of collection of assets that would produce all this cash flow over time. And that was his way of kind of the weighing machine of saying, well, just when you see it over here, what does that compare to somewhere else? And so when we get these rapid movements, we want to respect them and be aware of them, but we also want to sit there and say, was this a chance to compare it somehow to another asset that seemingly might be at this juncture left behind?
Yeah, and certainly not to say this is not an anti-gold
Yeah.
discussion. I mean, you've managed large portfolios of just Canadian equities, and you have gold exposure because there are some really good gold companies in Canada, and there's times where you want to be overweight or underweight gold. So you're not averse to gold. There's a reason why you'd have a little bit of gold in your portfolio. But it's more of just what we like to do is we're having these discussions for listeners is to just point out when things start to get to extremes and you want to just start to think about whether that's where you want to put your next dollar, or as you say, look at some of the other alternatives, or what the opportunity cost, I guess, would be if I put the money in gold, this is what I get. But if I put the money over here, I get all of this. And can I see a scenario where this could move? Yeah. So now I can take advantage of that.
Yeah, like I maybe to wrap it up, but just like, I was buying salt on the weekend,
Yeah.
and I really kind of sat there and said to myself, boy, I wish I bought this salt in the summertime because I'm paying full freight in the middle of a snowstorm for this salt, which unfortunately I really need at this juncture. So that's kind of like, when it gets to the market, like, there's what's in the focus right here and now, and then there's some things over here, and to say, well, boy, are the valuations interesting, and will they become in focus? And that's, so you're always wanted to simultaneously review this and think about, the other things that might be available.
Great way to wrap it up, Stu, and another good investment, Stu. And you need to get the right amount of salt in an investment, Stu, because it's important for the taste of that stew. So I'm glad you did focus on that. I'm also glad that you're not that you are, again, we're 5 years into this. You're older than you were when we started. So I'm glad you've hired someone to plow the driveway, because we don't want to we don't want you hurting yourself now that you're getting older.
Great. Well, thanks, Dave. Always good.
Thanks, Stu. We'll see you next week, or in 2 weeks actually. So we're gonna miss you next week, but in a couple of weeks we'll see you.
Great.
Take care.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.